Well, investors have been pushing up asset prices across the board, from stocks to bonds to commodities. But how long can this broad-based rally last? Joseph Mezrich is head of quantitative research at Nomura Securities International and joins me in the studio. And Joe, thanks so much for joining us. I find this topic really quite fascinating. I mean, this herd mentality that we've seen among asset classes, is it only going to get stronger or not?
It can get lower. I mean, really, there are two things going on. One is the fact that volatility has been high. So that'll tend to have a singular focus of the market, and that'll bring assets together. But the reason they're so connected is because of the derivatives market and financial technology, which lets basically investors do anything nowadays. So the correlations have been high for two reasons. Partly because the connections have been made available since, beginning of this millennium. And the volatility has created a focus on risk that's made the correlations go
Well,
higher.
help me understand that, though, because when volatility goes up, obviously that means there's a lot of fear in the markets then. So why would equities and treasuries go up at the same time? Because
you basically are focusing on risk aversion or risk seeking. So basically what's going on since March 9th, people are trying to take on opportunities that were basically thrown away during the crisis. When you're frightened, I mean, take an example, equities.
But then that's why we saw the crash back in October and November, is because when you saw volatility, when you saw the VIX index spike up to 80, that's when the equity market started to tank, and you saw treasuries rally. So help me explain. Help me.
Right, but think about corporate bonds and stocks as an example, right? So people were basically were frightened, so they basically pushed up yields and pushed down value stocks as there was fear of default in the market. So risk aversion basically percolates through the markets, through the connections that are available. So when volatility is high, it's all about finding a place to hide. And the connections made these opportunities very large. So basically, connections are becoming more amplified when risk aversion is increased. And when when volatility comes down, these risk aversion features basically diminish. So what's been going on is that the fear in the market has caused a very tight focus on basically doing what you can do to avoid the fear.
Okay.
And the current markets have made a lot of opportunities for that to be done across asset classes. That wasn't true maybe 20 years ago.
Right.
So you see these connections now that you had not seen before for two reasons. First, because of how volatility has been record high, and secondly, because connections have made the opportunities available to be exploited.
Now, we just heard a report from John Ehrlichman, our reporter, talking about the VIX and how it looks like it may be poised to fall. So does that mean then that the correlation, in your view, correlation is going to weaken going forward, let's say in the next few months?
Yeah, I mean, it's now basically half what it was March 9th and basically a third. But it's pre-Lehman days, basically. But it's still double what it was in 06. So if it comes down, correlations will drop. But the point is that it can come back up again if volatility goes up. So it's all about the volatility and risks in the market. That's why correlations are high. So
okay. Can we go deeper into derivatives? How derivatives exactly spurs this sort of broad-based move? I mean, how exactly?
Okay, think about something happened in the crisis that was kind of strange. Value investors were hurt. Okay, so why did that happen? So what emerged is that value stocks tend to be pricing default risk. Okay, so what happened in the credit crisis is that default risk became a big issue. So there was a fear of default risk. So if you think about a corporate bond, when people avoid credits, a corporate bond pays you why? Because of default risk. So basically, you can think about a corporate bond as being a longer treasury and shorter put on the corporation. So people just think about it and say, well, let me think about it from options point of view. If a corporate bond is basically nothing more than a long treasury and shorter put, well, let me think about that. I can think about a put in an equity market. So what you've seen since 2001 is a very tight tracking of option equity volatility and corporate spreads, because people trade these two together because of the credit derivatives market. You couldn't do that 20 years ago. But now if you see...
it didn't exist, right? Yeah,
So now if you see something going on in the corporate market and you say, oh, corporate bonds are rich, what does that mean in terms of an option? You can go trade it in the equity option market. And that gets into the equity cash market. So that's a new thing that didn't exist basically before late 90s.
Okay. Joseph, thanks so much. Very interesting research and analysis. Joseph Mezrich, head of quantitative research at Nomura Holdings.